Hi, Jim Cruzan here, and welcome to this quarter's Capital Market Review. Since we're finished with the first half of the year, we're going to call this our halftime report. So far this year, the markets have been really fairly strong. If the year ended right now, it would be a halfway decent year. Last year was certainly challenging, recovered quite strongly. A lot of that was because of a strong surging economy, more than likely powered by fading pandemic issues, as well as this massive fiscal stimulus that we've seen. In fact, we're at a point now where over 50% of our population has had at least one vaccine shot, which is really helping quite a bit one's feelings about a reopening. Equity markets have rallied, home prices have surged, and I heard an interesting fact that said that as of today, when compared to the end of 2019, the average household has seen a 17% increase in their net worth. All of this is very, very good news. That said, in the next months ahead, we may see some challenges. We're seeing strained and constrained supply chains, rising inflation, and labor market distortions as a result of some of this pandemic stimulus. Additionally, the Federal Reserve is getting some pressure to begin unwinding some of its own pandemic stimulus, low interest rates, all of which we should have some answers on as we move into the months ahead. So, as we always do, we try to come up with a theme for each quarterly review. And this theme was brought to us by one of our team members, Danielle Howard, Headwinds on the Horizon. Couldn't think of it as a better theme message than this title. Hopefully, we'll get a much better idea of what things look like in the coming months. Why we do this is because we feel the economy matters. We think it's important to dissect several of the major components of the economy: growth, jobs, profits, inflation, interest rates, in an effort to answer two important questions. Where are we today, and where are we heading? We want to get a lot of things right, but the two that we really try to concentrate on is understanding where we are in the economic cycle and what the Fed is more apt to do. Are they going to continue to loosen or make things even more accommodative, or start to restrict and pull back, which may create some headwinds for us in the future? We're going to look at a lot of these issues, and we're going to do it through today's agenda. We're going to start with a real quick pandemic overview and update. We're going to look at the pace of this recovery as it looks in terms of economic growth, jobs, profits. We will look at both fiscal and monetary policy. And we will look at the equity markets and the importance, as always, for strong diversification. So with that, let's move right in to this report, and we'll talk about the pandemic update. This is a great slide. It shows a lot of data regarding COVID and its effects on our economy. The blue line represents a 7-day moving average. It shows the number of confirmed cases. If we look at just January, we had over 260,000 cases. As of June, 15,000. This is clearly a result of swift and effective U.S. vaccination policies. Today, as I said before, over 50% of our population has at least one vaccination shot. And more importantly, 86% of our population over age 65 has now received also at least one dose. So the real issue The question is, where are we as it relates to herd immunization? The graph on the right somewhat tells that story. Here, it combines those vaccinated with those who have actually gotten the virus and have their own natural immunities. And we'll see that that number combined is nearly 70% today. And by government standards, 70 to 90% is kind of what we need to define this as herd immunization. That said, we're having some issues. It's progressing a bit slower. We're finding our younger population less willing to be vaccinated. The government is spending a lot of money on messaging. And hopefully we increase the amount of vaccinated population as we move both through the summer and then into the cooling seasons of fall and winter. But at this point, looking at this data alone, we're actually in really great shape. Let's talk a little bit about this recovery and the pace of it and how it filters through certain aspects of our economy. First, let's look at the federal funds and its financing. You know, apart from vaccination, we've had an unprecedented amount of fiscal stimulus, both from the Biden as well as the Trump administration. And it has proven to be a huge accelerant in terms of this recovery. We also had a nearly $2 trillion American Rescue Plan, which was signed into law in March. And it's beginning to work itself through the system. And it will provide some support and stimulus well through the end of this year, and perhaps even into 2022. This page really shows the impact of the recession and this fiscal stimulus and its effects on the budget. And it's not great. The data here is supplied by the Congressional Budget Office. It is through February. And it should be noted that these projections are more than likely an underestimate, as it doesn't talk about the pace of growth in terms of federal debt as it relates to things like additional spending for infrastructure, child care, or education. And we're also seeing this through the eyes of the CBO, which is also implying low interest rates for a very extended period of time. And we're not quite sure whether that, in fact, will be true or not. This slide talks a bit more about the recovery as it relates to economic growth. You see the huge drop in the gray line and the recovery since. What's important to look at here is the fact that it may very well be this quarter that we actually fully recover the full extent of the economic drop that we had because of COVID. And that would be huge. In fact, we are very close to annualizing GDP growth at something a bit closer to 10%. Again, that's an annualized figure. But it could be so strong that by the fourth quarter, we actually see about 7.5% true year-over-year growth. While these numbers are blockbuster and numbers that we haven't seen in many, many decades, or a generation for that matter, the expectation is they're going to fade at some point. This growth rate is not sustainable. And at some point, the thought is we will more than likely get back to a more traditional 2+% growth rate. We really can't talk about the economy without including job demand. Here, we've got a kind of a mixed bag. You know, in a 2-month period last year, from February through April, we lost 22 million jobs. And since then, we've recovered 14.7 million of those, or about 66%. But we still have a ways to go. The unemployment rate right now is about 5.8%. Additionally, we really don't expect to see unemployment drop as significantly as it has in the past. Structurally, we have some issues. It's harder to get workers to return to the workforce. More on that a bit later. Some of the reasons for that may very well be prolonged enhanced unemployment benefits, or lingering pandemic worries, or child care responsibilities, as well as early retirement, all of which has restrained the labor supply. And it really is a labor supply issue. The thought is, as we move into later this year and into the fall, we will see some improvement. Not a lot, but some. Starting this month, about half the states are eliminating some of the extra unemployment benefits, and the rest of the states, those benefits are expected to expire in September. So the thought is we should see our unemployment rate by the end of this year get down to about 5% from where it is today at about 5.8. And the thought is by the end of next year, 2022, those rates might be as low as 3.5 to 4. That's important because we'll see in a few moments how the Fed and its policy is geared not only toward inflation, but also toward unemployment. With labor demands rising and higher cost of labor due to enhanced unemployment benefits, employers effectively competing against the federal government, we've seen wage rates rise in an effort to lure people back to work. This chart shows an annualized year-over-2-year growth of wages. And JP Morgan, that produced these slides, did that to factor out the effects of last year alone. So year over 2 years. And what we're seeing is that wage rate increase is growing at a higher than normal rate, in spite of the effects just last year alone. This is important because this is a longer term trend, and it may very well prove to be much less transitory than what the Fed is currently expecting, or what the Fed is publicly suggesting. The deep recession also caused a huge drop in S&P 500 operating earnings in early 2020. Miraculously, we saw a big spike later in the year because of the influence of a lot of stimulus. And we are now seeing earnings hit and expected to hit all-time highs here this year, 2021. As the economy improves, financials and consumer discretionaries have seen an impressive rebound in earnings growth. In addition, the pandemic has appeared to have triggered some improvement in productivity as well in a lot of sectors of the economy. That said, growth from here may be a bit more problematic. From 2022, next year and beyond, slower expected economic growth, higher wage rates, higher interest rates, and potentially higher corporate taxes may make further profit gains much more difficult to achieve. So all of these things that are being dealt with are causing a tremendous amount of volatility, where the markets are up one day and down the next. One day favoring technology, the other day seeing massive losses in technology and improvement in value stocks, and on and on. I wish we had better clarity. We should get a better understanding over the course of the next few months. This graph talks about inflation. At the beginning of the recession, a collapse in oil prices triggered a further decline in what was already really low inflation. However, since then, inflation has heated up and spiked. Part of it is a surge in consumer spending. That has been met with supply challenges, and recent CPI or inflation reports have blown past expectations, with year-over-year CPI expecting to hit nearly 5% overall and 3.8% excluding food and energy, which I think is really interesting. Because when we think about inflation, we see it very quickly in both food and energy costs. The point of this is any discussion about where we go from here has to include a real thorough analysis of inflation and what that looks like. Eventually, inflation is going to dictate what happens to our economy. Let's move for a second and talk a bit about fiscal and monetary policy. The old saying is the Fed is omnipotent. The Fed can take a recession and turn it into a recovery, and can take a perfectly healthy economy and slow it down significantly. So looking at the Fed and analyzing Fed movement is also very important. In the first half of 2020, last year, the Fed took dramatic action to support the economy and cut interest rates to essentially zero, discount rate to 0 to 25 basis points. They also expanded significantly a number of their facilities and at the same time expanded their balance sheet. To add to that, in August of last year, the Fed adopted something called average inflation targeting. This strategy allows them to pause or kind of look the other way as inflation creeps above that all-important 2% target. They do this in an effort to make up for years where they undershot that same target. So right now, the thought is they will let inflation grow at a rate that's comfortably above 2% for a prolonged period until such point as we get to maximum employment. And by Fed commentary, that is something below 4%. So remember the comment I made just a moment ago about unemployment being 4% or less, probably not until late 2022, or a good 18 months from now. That's a long time to wait to adjust interest rates. That, in my opinion, is baked in the cake. That's the expectation. Should we see higher inflation? Should this higher inflation become something more than transitory? The Fed might have to take action sooner. And if they do, that would come as a somewhat surprise or shock to the economy. At the very end of this chart, you'll see this dot plot, these dots of where interest rates are expected to go. As of the last Fed meeting, where these dots were adjusted, which was March, there was no expectation of a rate increase in 2023. Today, we now are seeing and expecting several. So again, the Fed is talking about moving interest rates sooner than later. Interest rates are really low. We see that in terms of mortgage rates, financing cost, etc. But what does this all mean in terms of investing? Well, against the backdrop of rising inflation, interest rates are more than likely going to move higher. They're higher today than they were at the beginning of the year. They will more than likely be higher still here at some point. Bottom line is this could make it somewhat difficult for traditional bond or fixed income holdings. This chart is incredible. The peak of interest rates, 1981. By the way, that was the year I graduated college, with interest rates at all-time highs. And ever since, interest rates have been falling pretty significantly. They bottomed out and are starting to rise here a bit. More than likely will continue to rise over time. So with many of our accounts, to shelter us from this, we're using short duration or short maturities on our bonds. They are less sensitive to interest rates. We're also looking at what would be deemed as non-traditional fixed income strategies that can hedge out some of the interest rate volatility as well. This does not mean that bonds don't have a place in all of our portfolios. They still serve a purpose. Although they might not drive return, they certainly are useful as a means of portfolio insurance, protecting the accounts against a big drop from the equity markets. Speaking of equities, let's talk about S&P 500 valuations. Earnings are likely to continue to grow pretty quickly for the remainder of this year. Relatively low interest rates, they argue, helps to support higher valuations. But at the end of the day, valuations certainly seem a bit stretched. And when you look at the market through a number of filters based on historic levels, it seems pretty high. From a PE perspective, it's quite a bit higher than norm. From a cap rate perspective, that's cyclically adjusted PE, it's also much higher than norm. From a dividend yield, stocks are expensive, yields are lower than norm. From a price to book ratio, they're quite a bit higher than norm. And from a price to cash flow perspective, they're significantly higher than norm. And from a earnings spread, they still look attractive. And that's because of low interest rates. When interest rates start to rise, that last area of valuation, the last area supporting high market valuations, will come under some pressure. We're not saying the market's prone to crash anytime soon. We're just saying it's a whole lot harder to find things to invest in today with reasonable valuation that it can offer reasonable returns in the future. For most of our clients that are retired, for most of the industry that deal with retirees, widows, orphans, foundations, the approach is typically a balanced account. Our primary model is what we call balanced with growth. It's a tactical portfolio. We call it kind of bend but don't break, or Goldilocks. Consider it not too hot, not too cold. A traditional portfolio is about 60% equity, 40% fixed income. This chart talks about the effects of high stock valuations and low interest rates to future-looking return assumptions on a 60-40 unmanaged portfolio, where you just kind of buy and hold and let her rip. Looking at the earnings yield, which is the inverse of the PE, and taking that number, which is a good proxy for future growth on stocks, and taking 60% of that, and taking current bond yields as the proxy for bond earnings in the future, and take 40% of that, you see a return expectation of just above 3%. For years, we've been using a 4% distribution number. As I mentioned to some, a number of years ago, the Wharton School was suggesting that 4% number should really be more like a 3% number. And this is the reason why, especially if you're using a buy and hold strategy. With our core balance with growth portfolio, it tends to be a bit more tactical, where at any point in time, we may have a fair amount more equity than 60%, or a fair amount less. And we make adjustments to the portfolio in terms of stocks to bonds, US to international, large to small, growth to value. And all of these things can certainly help improve return over the longer term, to say nothing of better downside risk control. We've seen incredible growth in growth stocks. Think of last year, stuck at home, how we communicated, how we retail shopped, how we ordered groceries or ordered food from restaurants, how we entertained ourselves with streaming services. To a large degree, at the end of the day, that's all technology. And growth stocks have a large component of technology companies within their mix. So growth has done well for a number of years, especially in 2020. But value has begun recovering, and value has been performing really well to date. With the S&P up over 10% and beginning to look frothy and somewhat stretched, what's in store for the second half of the year? Does value still have room to run? This chart helps provide some insight to that. The gray line that you see on the left below the horizon would suggest that value is more cheaply valued, a better buy relative to growth. And when the gray line is above the horizon, the advantage goes to growth companies. So right now, the advantage may very well be with value. They tend to hold up better in rising interest rate environments. They tend to pay cash flow or dividends. And as many of you have reviewed with me or my team over the course of the last several months, we've been talking a bit about portfolio allocation and a slight overweight toward value. That said, it pays to be nimble, because at some point, maybe into late 2022 or 2023, the economy may very well slow down. And when it does, everything tends to reverse. Growth all of a sudden becomes a better performer than value. It holds its value better in a slowing economic environment. So it pays to be a bit more nimble. One other point on this, the chart or graph to the right talks about the components of the S&P as they relate to GDP. And you'll see things like industrials, financials, communication services, energy, which are all traditional value type companies, have far more sensitivity or correlation to an improving GDP. As GDP improves, those tend to do better. Speaking of value in the gross sense, it pays to look at international again. Now, look, I've been beating this drum for a long time. And I'll tell you, with most of our portfolios, we have a severe underweight in international at present. But when we look at the international markets, look at PEs, price earnings ratios, they're at 25-year lows. And I believe there is something to be said for mean reversion. Additionally, when you look at current government policy and our existing debt levels, which, by the way, debt as a relationship to GDP will match or exceed where we were coming out of World War II. That puts a lot of pressure on the US dollar. And we think the trend is for the dollar to weaken, which advantages international holdings, US purchasing international securities with US dollars. So not only do we get at some point the advantage of corporate growth as it relates to Europe and their rebounding from COVID and their economies reopening, but we also get another bump as a result of the differential in currency pricing. So while international is a low percentage of the portfolio relative to, let's say, full weighting, the expectation is it may be moving more in that direction here at some point. One last slide, and that has to do with valuation dispersion, or in some cases, the volatility of PE. You know, if the multiples change, if the multiples go down, valuations drop very quickly. If there's some reason to support higher valuation, stock prices go up. So valuation is directly correlated with stock price movement. And what we're seeing is the green line, which represents the longer term trend, has been trending up. So valuations generally are higher. A few slides ago, I showed how the current valuation is much higher than 25-year average. But the most important thing isn't the green line, it's the gray shading. And notice how it looks kind of like a funnel as we're moving left to right, it's widening out. That's volatility around the PE. And the point to all of this is when that gray shaded area is narrow, the advantage goes to passive strategies. Just buy an index. There's not a lot of volatility. It's super easy to invest. As things widen, as they're doing these days, the advantage goes to active management, the ability to select individual securities or sectors or specific geographic areas can have a big influence, a positive contribution to portfolio returns. And we're moving from a period where the advantage was for many years to passive indexing. It's moving a bit more toward active investment. And as a result, we're looking at portfolios adjusting, moving a bit more toward active as opposed to passive. Well, that's where we are in our halftime report. Again, we look to get two things right, and we spend a lot of time talking about this. Where we are in the economy, I would say as of this quarter, we've recovered, and now we're on to, in this case, it's called mature, but it's growth in the economy. At some point, we may actually slip back into slow growth, followed by what would then be another recession. And while the Fed has been full on in terms of accommodating, we think that that's going to be retarded here at some point. But those two things aren't the only things we look at. Every week we have our policy meeting. Every week we talk about COVID. We talk about where we are in terms of economic recovery, what stimulus spending looks like and its expectations. We look closely at the 10-year yield. Interest rates go up, interest rates go down. They have an impact on certain segments of the economy. And then obviously Fed policy. Like the theme was presented, there are changing headwinds, and we're trying to decipher that. So with that said, I'd like to offer to your friends, family, colleagues, acquaintances, if you know anybody who's expressed some concern about where we are in the economy, what's going on, high valuations, potential issues with policy out of Washington, we'd love to have a conversation. We'd love to be able to provide a second opinion, walk that individual through our evolutionary wealth process. And in that clarity meeting, we're going to give them, at least through our eyes, where we think they are in terms of retirement readiness. And we will offer them suggestions on what they might be able to do to improve their lot, reduce their risk, eliminate some of that anxiety. So if presented in that position, please think about us. And as always, if you have any questions at all about this, something you read, some question that was posed to you by a friend, colleague, child, pick up the phone, give us a call, shoot us an email. That's what we're here for, to help and service you. And with that in mind, I want to thank you. Have a terrific summer, and we look forward to talking to you again on this very same topic in October. Talk to you then. Take care.